CME Group reported earnings and the stock jumped 5%. But if you actually open the filing, something strange happens. The business got smaller. Fewer contracts traded, a lower fee on each one. And the money CME earns from trading actually fell. So the trading engine went backwards and the stock went up. Let me show you why. First, understand what this company is. CME Group is a toll booth. It does not bet on markets. It owns the road that traders drive on. Interest rates, oil, gold, wheat, stock indexes, every contract that crosses pays a small toll. And because there's almost nothing to manufacture, about 65 cents of every dollar it collects turns into profit. It is one of the best business models in American finance, which is exactly why this quarter is interesting. Because for the first time in a while, traffic on the road went down. Volume fell. The average toll fell, and profit from operations fell with them. So where did the earnings beat come from? Tax. CME received a one-time state tax benefit that pushed its tax rate down. Take that away, apply last year's rate, and adjusted profit per share was $2.96. Last year it was $2.96. Flat. Exactly flat. The beat was real. It just did not come from the business. So is that bad? Honestly, no. And this is where a lot of the coverage got it wrong. CME was not being compared to a normal quarter. It was being compared to the best second quarter it had ever had. Inside this one, May and June both set all-time volume records. And the first 6 months were the strongest half in company history. The data business, the part that sells prices and market information to banks and traders, hit a record and grew 20%. That is not a broken company. That is a very good business having an average quarter against an impossible comparison. Which brings us to the part that actually matters. What happens next? Here is the setup. Last year, the third quarter was the weakest stretch of the year. Traffic dropped hard. So this time, the comparison is not impossible anymore. It is easy. And the early numbers are already in. Through late July, volume is running 17% above last year, tracking the busiest July in company history. CME also raised fees this year, which adds roughly 1% to revenue on the same activity. And the pipeline is unusually full. Single stock futures, round-the-clock crypto and gold trading, even a futures market on computing power. So if July holds, the next report should look very different from this one. But be careful here. This company runs on volatility and nobody controls volatility. A calm, quiet market is the one thing that undoes all of it. Now the price. CME trades near 21 times earnings. Its own 10-year median is closer to 27. So it is cheaper than its own history. But cheaper than history only counts if the history repeats. That multiple was earned in years when volume grew every single year. One more thing worth knowing. That Wall Street price target showing 17% upside comes from 18 analysts. Every single one of them published before this report. Not one has updated. So this is my final verdict. If you are a low-risk taking investor, wait for the third quarter to show fees and volume back in growth, with margin near 65% before calling this stock cheap. But if you are a high-risk taking investor, a wide moat exchange, a 20% data compounder, and capital return above 100% of profit can justify a below-history multiple. So, with all that said, thank you so much for watching. And please don't forget to like and subscribe to the channel.